Price falls into the key low, but the bounce still cannot escape. The week forms inside lower weekly memory. This week was not only a drop, it was a fight around survival. The 1-hour chart gave trades every day. Longs formed from lower memory. Shorts formed after upper failure. Some trades paid. Some setups moved but did not deserve entry. That difference matters. A trader who only watches candles sees noise. A trader who watches session memory sees pressure. Every day, price reached a line. It either held or failed. Then the trade became possible. But the reason was not only inside the 1-hour chart. The higher time frame was already waiting. Monthly, weekly, daily, especially weekly. The weekly chart must stay in your head before any 1-hour trade. Without the weekly chart, this week looks strange. Price falls hard. Then it bounces. Then it stalls. Then it moves sideways near the same area. You expect recovery. You expect the market to return higher. But weekly 0.33 still blocks the move. Weekly 0.25 still waits below. The February 5th key low still controls lower risk. That is why this week cannot be read as a simple bounce. It is a trapped recovery inside lower memory. Look at the trading pressure. The market moved around old Asia and US boxes. Some sessions compressed. Some sessions expanded. Some sessions overlapped inside the same area again and again. Distance became shorter. Reactions came faster. Continuation failed earlier. When the line held, the long worked. When the line failed, the short worked. When the lines became too crowded, the account had to wait. That is real execution. Not every movement deserves a trade. Not every bounce deserves a long. Not every red candle deserves a short. The trade needs a stop. The trade needs an entry. The trade needs a target. The risk must deserve the reward. This week tested that rule. At the start, price was still working near the February 5th key low area. Then, 1-hour session boxes began to rotate around old lower memory. A target became a next entry. A failed top became a short trigger. A key low protected a long. A final crowded session gave movement but no clean ratio. That is the whole lesson. The market did not reward prediction. It rewarded reaction. Price reached. It failed. It returned. Price reached. It held. It moved. Then higher timeframe pressure decided how far the move could go. Now we connect it all. First, the 1-hour chart shows the live fight. Session line, stop line, entry line, target line, execution line. Then the daily chart shows why the drop traveled there. Then the weekly chart shows why price is still trapped. Then the monthly chart shows why the February low still matters. Watch the daily chart carefully. Watch the weekly chart even more carefully. Next week's 1-hour trades will not begin from nowhere. They will begin from these higher time frame lines. If price reclaims weekly 0.33 and holds, the long can form later. If price fails under 0.33 and returns lower, the short pressure can return. If price breaks toward weekly 0.25, the market becomes dangerous again. If price only rotates in the middle, no trade can save the account. That is why the weekly review matters. You are not watching a recap. You are preparing the next trade. The 1-hour chart gives the trigger. The higher time frame gives the field. Risk decides survival. Price bounces hard, but it does not escape the old box. The session forms inside expanded memory. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour candle can look strong and still fail. A bounce can look clean and still stay trapped. A short can look late and still work. So the 1-hour chart must be read through the higher time frame field. Now look at June 7th Asia session. June 7th Asia session forms with expansion. It expands about 150% compared with the June 4th US session box. It overlaps with that memory. That matters. A wide basis box changes the trade. A narrow box can create tight pressure. A wide box can create wider reaction. The support and resistance do not sit in one tight place. They spread out. Price can move inside the box and still not choose a clean direction. That is the first warning. June 7th Asia session continues inside its own basis box. But more accurately, price continues inside the June 4th US session box. That is important. The visible Asia structure expands, but the real working memory stays tied to June 4th US. Price does not create new freedom. It rotates inside old memory. That changes the trade. You do not chase the middle of the box. You wait for the old boundary. Now we build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price rising. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve action. So the trade starts with risk. June 7th Asia session long. Entry line. June 4th US session lower boundary. Stop loss line. June 5th US session midpoint. Take profit line. June 4th US session upper boundary. Risk-reward ratio 1.79. The entry sits at June 4th US session lower boundary. Why there? Because price is not trading a fresh open range. It is rotating inside June 4th US memory. The lower boundary is where buyers must prove control. If price reaches that old lower boundary and cannot hold, the long has no base. If price reaches it, reacts, and stays above it, the long can form. The entry is not chasing the bounce. The entry waits for the lower memory to hold. That matters. A bounce in the middle gives poor control. A bounce from the lower boundary gives a line. You can define the trade. You can define the failure. You can define the target. Price reaches the lower side. It reacts. It holds. Then the long becomes active. The stop sits at June 5th US session midpoint. That stop is not random. The long is built from June 4th US lower memory. But if price loses the June 5th US midpoint, the recovery has returned too deeply into lower pressure. The bounce is damaged. The long no longer has clean control. So the stop sits where the idea breaks. Not where it feels comfortable. Not where the candle looks pretty. Where the trade loses its reason. If price reaches that stop, the long is not the same trade anymore. Leave. No hope. No argument. No waiting for another candle. The target sits at June 4th US session upper boundary. Why there? Because price is moving inside June 4th US memory. If the lower boundary holds, the upper boundary becomes the clean return target. The goal is not unlimited upside. The goal is the opposite side of the working box. That is why the target is not far above the market. It is where price has a reason to react. Price moves toward the upper side. The target pays if the range completes. Risk-reward ratio is 1.79. That is acceptable but not perfect, so the execution must be clean. If entry is late, the ratio weakens. If the stop is widened, the ratio weakens. If price reaches near the target before entry, the trade must be skipped. A valid idea can become a bad trade when timing gets late. That is where discipline protects the account. Now watch the behavior. Price moves up from the lower memory. It tries to build distance. But the old box still controls it. Bodies do not expand freely. Pullbacks still appear. Reaction still comes back. The move can pay, but it cannot be treated as a fresh trend. That is why the target stays at June 4th U.S. upper boundary. Take the box seriously. The box gave the entry. The box gives the target. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays faster. But that is not free. A tight stop can be hit by normal reaction. Price can still move toward the target after the stop is hit. The trader was right about direction. But the position is gone. That pain must be respected. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, the conservative answer can become no trade. Here, the structure gives 1.79. So the trade can be studied. But it must be taken at the right line. Now think about trailing. If price reaches the first target and keeps holding, the trader may want more. But the target does not move just because the trader wants more. The market must earn the trail. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. If you trail too early, the trade cannot breathe. If you trail too late, the profit gives back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope, but the stop cannot be too tight. If normal reaction touches it, the trail damages the position. If the stop stays too far back, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. If price reaches the first target and reaction gets faster, a conservative trader protects more first. 60% first. 40% left for continuation. If price holds the target and distance keeps growing, an aggressive trader can leave more open. 40% first. 60% for continuation. If the move reaches multiple stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the percentage does not create the edge. The edge comes from the line. The edge comes from June 4th U.S. lower boundary holding. The edge comes from a target that pays. June 7th, Asia gives the first message. The box expands. Price bounces. But the old June 4th U.S. memory still controls the trade. The long works only when lower memory holds. Price reaches. It reacts. It holds. Then the trade begins. Price compresses again. But compression does not give freedom. The session forms inside old upper memory. Before reading June 8th U.S. session, keep the higher time frame field visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. These areas still shape the 1-hour chart. The market already bounced from lower pressure. But a bounce does not erase the larger field. A recovery can move up. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 8th U.S. session. June 8th U.S. session forms between June 4th U.S. session upper boundary and June 4th U.S. session midpoint. It compresses by about 50%. It overlaps there. That matters. June 7th Asia had expansion. June 8th U.S. has compression. The market moves from wide range into tighter decision. A compressed session box can make the next reaction faster. Price has less room to hide. The upper side becomes more important. The lower side becomes more important. But compression alone is not entry. Price must reach. Price must fail. Price must return. June 8th U.S. session moves inside its own basis box. It continues inside that compressed structure. It tests the upper side. It tests the lower side. It does not create clean freedom. The market rotates. Bodies shrink. Wicks grow. Reaction comes sooner. Continuation fails earlier. That is the pressure. Now the short setup appears. Short entry line. June 8th, U.S. session upper boundary. Stop loss line. Weekly 0.33 area. Take profit line. June 4th, U.S. session lower boundary. Risk-reward ratio. 1.86. The entry sits at June 8th U.S. session upper boundary. Why there? Because the session forms compressed under higher pressure. The upper boundary becomes the recovery test. If price reaches the upper boundary and stays above it, the short loses pressure. If price reaches the upper boundary and cannot hold, the bounce has failed. That failed hold becomes the short. The short does not start at the lower side. It starts where buyers fail to keep the upper side. That is the difference. Do not sell after price has already fallen through the box. That can be late. Sell only when the upper test fails and the risk still pays. Price reaches the upper boundary. It reacts. It cannot stay. Distance does not open upward. Reaction returns faster. Now the short has structure. The stop sits at weekly 0.33. That stop is important. Weekly 0.33 is not just a number. It is a higher time frame pressure line. If price recovers above that area and holds, the short idea changes. The 1-hour failure is no longer clean. The higher time frame pressure is being reclaimed. So the stop must respect that line. A stop inside the small box may improve the ratio, but it may not protect the real idea. If price pushes above the compressed box and attacks weekly 0.33, the short is already under pressure. If price holds there, the short should not remain open. So the stop belongs near weekly 0.33. It defines the failure. The target sits at June 4th U.S. session lower boundary. Why there? Because the trade is still working inside June 4th U.S. memory. The same old box controls both sessions. June 7th long used June 4th U.S. lower to upper. June 8th short uses June 8th upper failure toward June 4th U.S. lower. The old lower boundary becomes the target. That is why the target is not chosen emotionally. It is the next meaningful working memory. If price fails near the upper compressed zone, the return target is the old June 4th U.S. lower boundary. Risk-reward ratio is 1.86. That is above the minimum filter. But it is not large enough for sloppy execution. Entry must be near the actual upper boundary. Stop must not be widened without reason. Target must not be moved lower before price earns distance. If the trader enters late, the ratio weakens. If the trader chases after the first red candle, the target gets too close. If the trader widens the stop above weekly 0.33, the trade can lose quality. so execution must be tight but not fragile. That is the hard part. Tight execution is not the same as a tight stop. Tight execution means the entry is taken near the real line. The stop still belongs where the idea fails. Now compare the long and short. June 7th Asia gave a long from old lower memory. Risk-reward ratio, 1.79. June 8th US gives a short from compressed upper memory. Risk-reward ratio, 1.86. Both trades are not extreme. Both trades require discipline. Both trades depend on the same old June 4th US box. That is the lesson. The market is not giving a clean trend. It is giving rotation inside old memory. Long from lower memory. Short from upper failure. The trader must not get married to direction. The trader must read the boundary. Now trader type again. An aggressive trader may tighten the stop below weekly 0.33. The ratio improves. The position size can increase. Sometimes that works. Price never reaches the tighter stop. The short pays. But compressed boxes can whip. A wick can reach. A reaction can touch. Then price can still drop. The idea was right. The position is gone. A conservative trader gives the structure room. The stop respects weekly 0.33. The position size becomes smaller. The trade survives more noise. But if the wider stop makes the ratio too weak, no trade becomes the conservative answer. Here the trade still has 1.86. So it can be considered. But only if entry is clean. Now management. If price moves toward June 4th US lower boundary, protect. Do not assume continuation. The market is still inside a higher time frame field. The same lower boundary that worked as long entry before can create reaction again. If price reaches the target and stalls, take the result. If price breaks through and holds lower, only then can trailing be considered. The trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop must follow structure. Not the last red candle, not the feeling that the trade should keep going. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now, the final view. June 8th US forms compressed between June 4th US upper boundary and midpoint. Price tests both sides. It cannot leave cleanly. The short forms at June 8th US upper boundary. The stop sits at weekly 0.33. The target sits at June 4th US lower boundary. Risk-reward ratio, 1.86. The setup is not a prediction. It is a condition. If the upper side holds, no short. If the upper side fails and price returns lower, the short becomes active. If the entry becomes late, no trade. If the target gets too close, no trade. If the risk-reward breaks, no trade. Today's chart needs the higher time frame. If the movement feels confusing, go back to monthly, weekly, and daily. Especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. Price reaches. It reacts. It holds or fails. And the trade only happens when the risk deserves the reward. Price bounces inside the trap, but it cannot escape the old box. The session forms inside compressed memory. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour bounce can look strong and still fail. A short can look obvious and still return. A long can work, but only if the memory holds. A short can work, but only if the recovery fails. That is why the session line matters. Now look at June 8th Asia session. June 8th Asia session forms inside June 8th US session box. It compresses by about 50%. It overlaps. That matters. A compressed box creates faster decision pressure. Price has less space to hide. Reaction comes sooner. Continuation fails earlier. The box does not give freedom. It gives a test. June 8th Asia session first moves lower. It reaches June 4th US session lower boundary. It tests that old memory. Then price moves up. It reaches June 8th Asia session midpoint. It tests the middle. Then price falls again. It returns to June 4th US session lower boundary. The movement is not random. It is a rotation between old lower memory and the compressed midpoint. Lower memory holds. Midpoint reacts. Lower memory gets tested again. That is the structure. Now we build the first trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price bounce. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve action. So the long starts with risk. June 8th Asia long setup. Entry line. June 4th US session lower boundary. Stop loss line. June 7th Asia session lower boundary. Take profit line. June 8th Asia session midpoint. Risk-reward ratio. 1.82. The entry sits at June 4th US session lower boundary. Why there? Because the market is still working inside old memory. June 8th Asia is compressed, but the real lower reaction comes from June 4th US memory. If price reaches June 4th US lower boundary and fails to hold, the long has no base. If price reaches that lower boundary and reacts upward, the long can form. The entry is not the green candle. The entry is the hold. Price reaches the lower boundary. It reacts. It does not break lower. Distance starts to open upward. Then the long becomes active. The stop sits at June 7th Asia session lower boundary. That stop protects the structure. The long depends on June 4th US lower memory holding. But if price loses the June 7th Asia lower boundary, the recovery has fallen too deep. The bounce no longer has clean control. The position no longer has protection. So that line becomes the failure line. If price touches it, the long is not the same trade anymore. Leave. No hope. No argument. No waiting for another candle. The target sits at June 8th Asia session midpoint. That target is not aggressive. It is realistic. Price is not yet in a clean trend. It is rotating inside compressed memory. The midpoint is the first place where price can stall. The midpoint is the first place where buyers must prove they can push further. So the target belongs there. Risk-reward ratio. 1.82. That is tradable. But it is not big enough for sloppy execution. If the trader enters late after price already moves toward the midpoint, the ratio weakens. If the trader widens the stop below June 7th Asia lower boundary, the ratio weakens. If the trader ignores the midpoint and expects a full breakout, the trade becomes hope. So the long must be taken at the lower memory, not in the middle, not near the target. Now price reaches the midpoint. It reacts. It cannot build clean continuation. Distance starts to shrink. Bodies become smaller. Pullbacks deepen. Reaction comes back faster. The same level now changes role. June 8th Asia midpoint was the long target. After price reaches it and cannot stay, it becomes the short entry. That is why session memory matters. The target can become the next entry, but only after failure. Now the additional short setup appears. Short entry line. June 8th, Asia session midpoint. Stop loss line. June 8th, US session upper boundary. Take profit line. June 4th, US session lower boundary. Risk-reward ratio 1.82. The short does not come from guessing the top. It comes from failed continuation at the midpoint. Price reaches the midpoint. It tries to stay. It cannot. Reaction speeds up. Distance becomes shorter. The move returns lower. Now the midpoint becomes a sell decision. The stop sits at June 8th US session upper boundary. Why there? Because the short is based on the midpoint failing. If price recovers above the June 8th US upper boundary, the failure is no longer clean. The compressed structure has been reclaimed. The short has lost control. So the stop belongs there. The target returns to June 4th US lower boundary. That is the same old lower memory. The long used that level as entry. The short uses that level as target. Same box. Opposite trade. That is how rotation works. Long from lower memory. Short from midpoint failure. Both setups carry the same risk-reward ratio, 1.82. That is important. The market is not giving a free trend. It is giving a controlled rotation. The trader must not get attached to direction. Direction changes. Structure decides. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays. But compressed boxes can whip. A wick can touch the stop. Reaction can remove the position. Then price can still move in the planned direction. The idea was right. The position is gone. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, no trade becomes the conservative answer. Here, both setups give 1.82, so they can be studied, but only if entry stays close to the line. Now management. If price reaches the target, protect. Do not assume the next move. The box is still controlling the trade. If the long reaches the midpoint and stalls, take the result. If the short reaches June 4th US lower boundary and reaction appears, protect the result. A trail needs to be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the position. If the stop stays too far behind, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last candle. Partial profit can help. If price reaches the first target and reaction gets faster, a conservative trader protects more first. 60% first. 40% left for continuation. If price holds and distance keeps growing, an aggressive trader can leave more open. 40% first, 60% for continuation. If the move reaches multiple stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create edge. The edge comes from the line. The edge comes from lower memory holding. The edge comes from midpoint failure. June 8th, Asia gives the first message. The market bounces. Then it fails. Then it returns. The same box gives both trades. Long from lower memory. Short from midpoint failure. Price reaches. It reacts. It holds or fails. Then the trader acts. Price returns to lower memory. But the bounce still needs proof. The session forms inside compressed overlap. Before reading June 9th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market already tested lower areas. The bounce can appear. But a bounce does not erase the larger field. A recovery can move up. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 9th U.S. session. June 9th U.S. session forms between June 4th U.S. session lower boundary and June 5th U.S. session upper boundary. It compresses and overlaps there. That matters. This is not a fresh open space. It forms where two old memories meet. June 4th U.S. lower boundary. June 5th U.S. upper boundary. That overlap creates a decision area. Price has to decide whether lower memory can hold again. The session forms at the boundary of old support and old resistance. That kind of location can create fast reaction, but it can also create traps. The session moves lower first. It tests June 5th basis box lower boundary. That is lower memory. Then price moves up. It tests June 9th basis box lower boundary. The move does not break free. It returns from lower memory into the new box. The structure is a lower bounce, not a clean breakout. That difference matters. Now build the long setup in the correct order. Stop line first. Entry line second. Target line third. June 9th U.S. long setup. Entry line. June 5th U.S. session lower boundary. Stop loss line. February 5th key low. Take profit line. June 9th U.S. session lower boundary. Risk-reward ratio. 1.66. The entry sits at June 5th U.S. session lower boundary. Why there? Because price tested lower memory and reacted. The long is not chasing a sudden green candle. The long uses old lower memory as the base. If June 5th U.S. lower boundary holds, the bounce can move back toward June 9th U.S. lower boundary. If that lower memory fails, the trade loses control. The entry must happen near the lower memory, not after the bounce already runs. If entry is late, the ratio disappears. The stop sits at February 5th key low. That stop is important. The February 5th key low is not just another line. It is a major higher time frame memory. The weekly map already marked it. The market already reacted around it. If price loses that key low, the long is damaged at a larger level. The bounce is no longer only a 1-hour problem. It becomes a higher time frame failure. So the stop belongs there. A tighter stop may improve the ratio, but it may not protect the real idea. If price dips below the minor session line and holds above the key low, the long may still be alive. But if price loses the February 5th key low, the long no longer has a base. That is why the stop sits there. The target sits at June 9th U.S. session lower boundary. That may sound conservative, but the move is still a lower bounce. The market is not yet free. The target is the first return into the new session structure. Price must reclaim that lower boundary before it can do anything more. So the target is not the top of the box. The first target is the line price must recover. June 9th, U.S. lower boundary. Risk-reward ratio, 1.66. That is acceptable, but not generous. The trade needs clean execution. Entry must stay near June 5th U.S. lower boundary. Stop must stay connected to the February 5th key low. Target must be respected. If price reaches the target and stalls, take the result. Do not turn a lower bounce into a trend idea without proof. Now watch the behavior. Price moves down. It tests the lower side. It reacts. Then it moves back toward June 9th U.S. lower boundary. But the bounce is not free. Bodies remain controlled. Distance stays limited. Reaction can come back quickly. The market is still below larger pressure. So the trader must manage the position fast. The long is not a prediction of full reversal. It is a trade from lower memory to the first reclaim line. That is all. If price reclaims June 9th U.S. lower boundary and holds above it, a new structure can form later. But until that happens, the trade is limited. That is how we avoid chasing. Now compare June 8th and June 9th. June 8th Asia gave rotation inside old June 4th U.S. memory. Long from lower memory. Short from midpoint failure. June 9th U.S. gives a lower bounce from June 5th U.S. lower boundary. Stop at February 5th key low. Target at June 9th U.S. lower boundary. The structure is smaller. The ratio is lower. The trade demands more discipline. Risk-reward ratio, 1.66. That is not enough for careless execution. Now trader type again. An aggressive trader may tighten the stop above the February 5th key low. The ratio improves. The position size can increase. Sometimes that works. But near a key low, wicks can be violent. Price can dip. Price can shake. Price can touch the tight stop. Then it can return. The idea survives. The position dies. A conservative trader uses the key low as the real failure line. The position size becomes smaller. The trade gets room. But if the wider stop reduces the reward too much, no trade becomes the better answer. Here, the ratio is 1.66. The trade is possible, but not comfortable, so the entry must be precise. Now management. If price reaches June 9th U.S. lower boundary, protect. That line can reject. It can turn from target into resistance. If price holds above it and builds distance, then a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop must follow structure. Not the last green candle. Not the feeling that the bottom is in. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now the final read. June 9th US forms between June 4th US lower memory and June 5th US upper memory. It compresses. It overlaps. Price tests June 5th US lower boundary. It reacts. It returns toward June 9th US lower boundary. Long setup. Entry. June 5th US lower boundary. Stop. February 5th key low. Target. June 9th US lower boundary. Risk-reward ratio 1.66. The setup is not a full reversal. It is a lower memory bounce. If the lower memory holds, the trade can work. If the key low fails, the trade is wrong. If the entry becomes late, no trade. If the target gets too close, no trade. If the risk-reward breaks, no trade. Today's chart needs the higher time frame. If the movement feels confusing, go back to monthly, weekly, and daily, especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. Price reaches. It reacts. It holds or fails. And the trade only happens when the risk deserves the reward. Price drops first. But the lower memory does not break. The session forms below compressed pressure. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. If price moves near those areas, 1-hour movement can look clean and still trap you. A breakdown can look strong and still hit old lower memory. A bounce can look strong and still fail at the next session line. A long can work only after the lower memory survives. A short can work only after recovery fails. That is why the session line matters. Now look at June 9th Asia session. June 9th Asia session forms below June 9th US session box. It forms compressed. It overlaps under that pressure. The session forms at the boundary of lower acceptance and old resistance. That matters. When a session forms below another session box, price is not in free recovery. It is still trading under pressure. But when the box is compressed, the decision comes faster. There is less room to hide. Moves stall earlier. Pullbacks deepen faster. Reaction comes sooner. Continuation fails earlier. June 9th Asia session first moves lower. It reaches June 5th US session lower boundary. It tests that lower memory. Then price moves up. It reaches June 9th Asia session lower boundary. It tests the underside of its own compressed box. That movement creates two trades. Short first, then long. But only if the lines survive. We build the first trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price moving down. They want to short. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve action. So the short starts with risk. June 9th Asia short setup. Entry line. June 9th Asia session lower boundary. Stop loss line. June 9th US session lower boundary. Take profit line. June 5th US session lower boundary. Risk-reward ratio 1.94. The entry sits at June 9th Asia session lower boundary. Why there? Because price is trading under the June 9th U.S. session box. The Asia box forms below it. If price reaches the Asia lower boundary and cannot reclaim above it, sellers keep control. The lower boundary becomes the sell decision. The short is not chasing the lowest candle. The short is taken when price fails to return above the compressed session line. Price reaches the line. It cannot stay above. Distance does not open upward. Reaction comes back. Then the short becomes active. The stop sits at June 9th U.S. session, lower boundary. That stop protects the real failure point. The short works while price stays below the stronger U.S. session memory. If price recovers into the June 9th U.S. lower boundary and holds there, the short pressure changes. The market has reclaimed the line that was supposed to reject it. The short loses control. So the stop belongs there. Not too close to the candle. Not too far away from the structure. At the line where the idea breaks. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at June 5th U.S. session lower boundary. Why there? Because price is dropping toward old lower memory. The target is not chosen because it looks far. It is chosen because price has a reason to react there. June 5th U.S. lower boundary already worked as lower memory. If price reaches that area, buyers can appear. Shorts can cover. Reaction can speed up. So the target belongs there. Risk-reward ratio is 1.94. That is tradable. But it still requires clean execution. If entry is late after price already falls away from June 9th Asia lower boundary, the ratio weakens. If the stop is widened beyond June 9th U.S. lower boundary without reason, the ratio weakens. If the target is pushed lower before price earns distance, the trade becomes hope. The short must be taken at the failure line. Not after the easy distance is gone. Now price reaches June 5th U.S. lower boundary. It reacts. It cannot keep falling cleanly. The distance becomes shorter. Reaction starts coming upward. Now the same target becomes the next decision. This is where traders freeze. They just took a short. They want the market to keep falling. But the structure changes. The target has been reached. Lower memory appears. The next trade can become long, but only if the lower memory holds. Now build the second trade. Long setup after the short target. Entry line. June 5th U.S. session lower boundary. Stop loss line. February 5th key low. Take profit line. June 9th Asia session upper boundary. Trailing target. June 9th U.S. session upper boundary. Risk-reward ratio. 2.32 after trailing. The entry sits at June 5th U.S. lower boundary. Why there? Because that line is the lower memory that stopped the short. The market reached it. It reacted. It did not continue cleanly lower. The long begins only after that lower memory survives. The entry is not a random bottom pick. The entry is the reaction from old memory. Price reaches. It holds. It returns upward. Then the long becomes active. The stop sits at February 5th key low. That line matters. It is not just another intraday line. It is a major higher time frame memory. The weekly chart already marked it. Price has already reacted around it. If price loses the February 5th key low, the long is damaged at a larger level. The trade no longer has a base. A tighter stop may make the ratio look better, but it may not protect the actual idea. Near a key low, wicks can be violent. Price can dip. Price can shake. Price can remove a tight stop. Then it can bounce. A conservative stop respects the real failure line. That line is February 5th key low. The first target sits at June 9th Asia session upper boundary. Why there? Because price is moving back through the Asia box after lower memory holds. The upper boundary becomes the first full return target. If price reaches that area and stalls, protect. Do not assume full reversal. The market is still inside higher timeframe pressure, but the move earns more distance. Then the trailing target can extend toward June 9th U.S. session upper boundary. That is where the trade grows from a lower memory bounce into a larger session return. The trail is not random. Price must first earn the move. It must reclaim distance. It must keep reaction from getting too fast. If price reaches the first target and still holds, the next memory becomes available. June 9th U.S. upper boundary becomes the trailing target. Risk-reward ratio becomes 2.32. That is the stronger payoff. But the trail must protect profit. A target that moves without a stop is only hope. When the target moves, the stop must follow. The trailing gap should not be too tight. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. If the stop is too tight, normal reaction can touch it. Then the trader exits before the real target. If the stop is too loose, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. If the trade reaches multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not create edge. The edge comes from the line. The edge comes from short failure at the target. The edge comes from lower memory holding. June 9th, Asia gives the lesson. Short from the lower boundary failure. Long from the old lower memory hold. The trader must not marry direction. Direction changes. Structure decides. Price reaches. It reacts. It fails or holds. Then the trade begins. Price rises into pressure. But the upper side cannot stay clean. The session forms around overlapping memory. Before reading June 10th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has bounced from lower memory, but a bounce does not erase the field. A recovery can move up. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 10th U.S. session. June 10th U.S. session forms between June 5th U.S. session midpoint and June 4th U.S. session lower boundary. It fully contains the June 9th Asia session box. It overlaps that memory. The session forms inside a larger decision area. That matters. When a new session contains the prior Asia box, price is no longer dealing with one small line. The new session absorbs the old range. The market is building around the same battle. Old lower memory. New upper boundary. Prior Asia structure. The box becomes the working field. A contained box can create traps. Price can move above the prior small structure and still fail inside the larger session. Price can move below the prior small structure and still react inside the larger session. So the trader must focus on the working boundary, not the middle. After the session forms, price moves higher. It tests June 9th U.S. session upper boundary. It reaches the upper memory. Then price begins to fail. It moves lower. It tries to test June 10th U.S. session lower boundary. The movement is simple. Reach upper memory. Fail to stay. Return toward lower memory. That is the short setup. Now build the trade in the correct order. Stop line first. Entry line second. Target line third. June 10th U.S. short setup. Entry line. June 10th U.S. session upper boundary. Stop loss line. June 10th U.S. session upper boundary, 150% area. Take profit line. June 9th Asia session lower boundary. Risk-reward ratio, 1.63. The entry sits at June 10th U.S. session upper boundary. Why there? Because price is testing the top of the active session. If price reaches the upper boundary and holds above it, the short has no reason. If price reaches the upper boundary and fails to stay, the recovery loses pressure. That failure becomes the short. The short does not start because price is red. It starts because price cannot hold the active upper boundary. Price reaches. It reacts. It cannot stay. Distance does not open upward. Continuation fails earlier. Reaction comes back faster. Then the short becomes active. The stop sits at the June 10th U.S. upper boundary 150% area. That stop is shallow. That creates risk. A shallow stop can improve the ratio. It can also get hit by normal reaction. So this setup is not for careless entry. The stop only makes sense because the target is close enough and the ratio still pays above the filter. Risk-reward ratio is 1.63. It is above 1.5. But not by much. The entry must be clean. The stop must match the failure logic. The target must be close enough to pay before the market turns. If the trader enters late, the ratio weakens. If the trader widens the stop, the ratio can disappear. If the trader hesitates after the upper boundary failure, the trade becomes worse. So this short needs precision. The target sits at June 9th Asia session lower boundary. Why there? Because the June 10th U.S. session contains the June 9th Asia box. The lower side of that Asia memory becomes the next target. If price fails from the June 10th U.S. upper boundary, it can return into the contained Asia memory. The first clean destination is June 9th Asia lower boundary. That is why the target is not far away. The target is close. But the risk is also shallow. The trade can be attempted because the nearby target still gives more than 1.5. This is a tight execution trade, not a wide trend trade. Now consider the alternative. If the stop is not shallow, if the stop is placed at June 4th U.S. session midpoint, or if the stop is placed at June 8th U.S. session lower boundary, then the trade changes. The stop becomes deeper. The position size must become smaller. The target must also move farther. If the stop moves deeper, the target must be at least June 5th U.S. session lower boundary or beyond. Otherwise, the risk-reward fails. That is the key. A conservative stop needs a larger target. A tight target cannot pay a wide stop. Many traders lose here. They want conservative stop protection, but they keep the same close target. Then the ratio collapses. The trade looks safe, but the math fails. If the stop is wide, the target must expand. If the target cannot expand, no trade. That is the filter. Now watch the behavior. Price rises into June 10th U.S. upper boundary. It cannot hold. The move stalls. Pullbacks deepen. Bodies stop expanding. Reaction speeds up. Then price rotates down. The short is not emotional. It is the response to failed holding. If price had held above the upper boundary, no short. If price had reclaimed and stayed above the 150% stop area, no short. If price had already moved too close to June 9th Asia lower boundary, no short. The trade only exists when the upper failure still leaves enough distance to the target. Risk-reward ratio, 1.63. That number controls the decision. Now trader type matters. An aggressive trader may accept the shallow stop. The stop is tight. Position size can become larger. The target is close. The move can pay fast. But the risk is clear. A wick can remove the position. A small push above the upper boundary can hit the stop. Then price can still return lower. The idea may be right. The position may be gone. So an aggressive trader must accept that pain. A conservative trader may use a deeper stop. June 4th U.S. midpoint. Or June 8th U.S. lower boundary. That gives the trade more room. But the position size must be smaller. And the target must move lower. At least June 5th U.S. lower boundary or beyond. If that target is not realistic, the conservative trader should skip. This is how both traders can use the same structure differently. Aggressive trade. Tighter stop. Closer target. Higher size. More stop-out risk. Conservative trade. Wider stop. Farther target. Lower size. More survival. But both need risk-reward. Without reward, no trade. Now management. If price reaches June 9th Asia lower boundary, protect. Do not assume the breakdown continues. That line can react. It is prior Asia lower memory. If price reaches it and stalls, take the result. If price breaks it and holds below it, then a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop must follow structure. Not the last red candle. Not the feeling that sellers are in control. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now the final read. June 10th U.S. session forms between June 5th U.S. midpoint and June 4th U.S. lower boundary. It contains June 9th Asia session box. Price rises to June 9th U.S. upper boundary. Then it fails. Short setup. Entry. June 10th U.S. upper boundary. Stop. June 10th U.S. upper boundary. 150% area. Target. June 9th Asia lower boundary. Risk-reward ratio. 1.63. The trade is possible because the stop is shallow and the target is close. But the risk is also real. If the stop is widened, the target must move lower. If the target cannot move lower, no trade. Today's chart needs the higher time frame. If the movement feels confusing, go back to monthly, weekly, and daily, especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. Price reaches. It reacts. It holds or fails. And the trade only happens when the risk deserves the reward. Price pushes higher, but it still moves under old resistance. The session forms below compressed memory. Before any 1-hour trade, the higher time frame must come first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those lines are not background. They are the field. When price moves near those areas, a 1-hour bounce can look strong and still stay trapped. A breakout can look clean and still fail at the next box. A long can work, but only when lower memory holds. A short can work, but only when recovery fails. That is why the session line matters. Now look at June 10th Asia session. June 10th Asia session forms below June 10th US session box. It forms compressed. It overlaps underneath that memory. The session forms at the boundary of lower recovery and upper pressure. That matters. A compressed session box does not give wide freedom. It gives a tight test. Distance becomes shorter. Reaction comes faster. Continuation can fail earlier. Price has less room to hide. After June 10th Asia forms, price moves higher. It breaks above June 10th US session upper boundary. Then it pushes toward June 8th US session lower boundary. The move looks strong, but it is still moving into old resistance. It is not a free trend yet. It is a recovery through stacked session memory. So the long must be built from the line, not from excitement. We use the same order every time. Stop line first, entry line second, target line third. Most traders begin with entry. They see a green candle. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the trade does not deserve action. So the long starts with risk. June 10th Asia long setup. Entry line. June 10th Asia session upper boundary. Stop loss line. June 5th US session lower boundary. Take profit line. June 9th US session upper boundary. Risk-reward ratio 1.58. The entry sits at June 10th Asia session upper boundary. Why there? Because price must prove that the compressed Asia box can push above its own upper side. If price stays below that upper boundary, the recovery is not ready. If price reaches the upper boundary, breaks through, and holds above it, buyers show control. The entry is not the first green candle. The entry is the hold above the active session line. Price reaches. It breaks. It holds. Then the long becomes active. The stop sits at June 5th US session lower boundary. That stop may look deep, but it protects the real base of the trade. The long depends on recovery from lower memory. If price loses June 5th US lower boundary, the market has returned too deeply into the old lower structure. The bounce no longer has clean control. So that line becomes the failure line. If price reaches it, the long is no longer the same trade. Leave. No hope. No argument. No waiting for one more candle. The target sits at June 9th US session upper boundary. Why there? Because price is pushing back into the upper memory created before. That upper boundary is where reaction can appear. It is where buyers must prove that the recovery can continue. So the target does not sit randomly above price. It sits at the next working session memory. Price reaches the June 10th Asia upper boundary. It holds. Distance opens upward. The target becomes June 9th US upper boundary. Risk-reward ratio is 1.58. That is just above the minimum filter. So execution must be clean. If the entry is late, the ratio weakens. If the stop is widened, the ratio weakens. If the target is moved higher before price earns distance, the trade becomes hope. This long is not a wide trend trade. It is a recovery trade from compressed lower memory into old upper memory. Now watch the behavior. Price pushes higher, but the move is not smooth. Pullbacks appear. Reaction comes back. The market still sits inside a crowded session field. That is why the trader cannot relax. If price moves toward the target and stalls, protect. If price keeps distance, let the trade work. If price loses the active line, reduce risk. The trade is valid because the line holds, not because the market feels bullish. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays. But compressed boxes can whip. A wick can touch the tight stop. Then price can still move toward the target. The idea was right. The position is gone. That pain must be accepted. A conservative trader gives the structure more room. The stop respects deeper memory. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, no trade becomes the conservative answer. Here, the ratio is 1.58. It is tradable, but not generous. So the entry must be close to the line. Now management. If price reaches the target, protect. Do not assume the next breakout. June 9th U.S. upper boundary can reject price. If price reaches it and stalls, take the result. If price breaks it and holds above it, then a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope, but the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last green candle. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not create edge. The edge comes from the line. The edge comes from compression holding. The edge comes from risk-reward staying alive. June 10th, Asia gives the first message. Price rises. But it rises through old memory. The long works only when the compressed upper boundary holds. Price reaches. It reacts. It holds. Then the trade begins. Price lifts again, but the box still refuses freedom. The session forms near the same middle memory. Before reading June 11th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. These levels still shape the 1-hour chart. The market has already bounced from lower memory. But a bounce does not erase the field. A recovery can move higher. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 11th U.S. session. June 11th U.S. session forms near the June 4th U.S. session midpoint. It compresses to about 30%. It overlaps there. That matters. For the recent week, Asia sessions and U.S. sessions have been clustering in a specific area. Compression appears. Expansion appears. Overlap appears. Again and again. The daily chart shows that crowding clearly. The 1-hour chart feels noisy because the larger structure is packed with memory. Price is not moving through empty space. It is moving through layered boxes. That creates fast reactions. It creates short distance. It creates early failure. So the session line becomes more important. June 11th U.S. session forms inside this dense area. Then price moves lower. It tests June 10th U.S. session upper boundary. It also tests June 5th U.S. session upper boundary area. Then price moves higher again. It tries to test June 8th U.S. session upper area. The move is not random. It is a rotation from lower held memory toward upper memory. Now the trade must be built from risk. Stop line first. Entry line second. Target line third. June 11th U.S. long setup. Entry line. June 10th U.S. session upper boundary. Stop loss line. June 10th U.S. session midpoint. Take profit line. June 8th U.S. session midpoint. Risk-reward ratio 2.29. The entry sits at June 10th U.S. session upper boundary. Why there? Because price tested that line from above and had to hold it. If price loses June 10th U.S. upper boundary, the recovery falls back into the prior session body. The long becomes weak. But if price reaches that upper boundary, reacts and holds, buyers defend the old breakout line. That creates the long. The entry is not the upward candle. The entry is the defended line. Price falls into the line. It cannot break lower. Reaction turns up. Distance starts to open upward. Then the long becomes active. The stop sits at June 10th U.S. session midpoint. That stop protects the trade without giving too much room. The long depends on June 10th U.S. upper boundary holding. If price loses the midpoint of that same session box, the defense has failed too deeply. The market has returned into the center of the prior structure. The long no longer has clean control. So the stop belongs at the midpoint, not because it is close, because the idea changes there. If price reaches that midpoint, leave. No waiting. No argument. No second guess. The target sits at June 8th U.S. session midpoint. Why there? Because June 8th U.S. memory is still above. The market is moving from defended June 10th memory toward the next older midpoint. The June 8th U.S. midpoint is not the highest line, but it is the first meaningful target where price can react. It gives enough distance. It keeps the trade realistic. Risk-reward ratio is 2.29. That is stronger than the first long. Now the trade has room. The entry is clear. The stop is defined. The target pays. That is the difference. The same bounce can be weak if the ratio fails. The same bounce can be valid if the lines align. Here, the lines align. Now watch the behavior. Price reaches the lower test. It holds. Then the reaction moves higher. But the move still stays inside crowded session memory. The trader must not turn this into a prediction. It is a trade from one defended line to the next working target. If price reaches June 8th U.S. midpoint and stalls, protect. If price breaks through and holds, a new structure can form later. But until the hold appears, the first job is to take the target seriously. The target is where profit must be protected, not where hope begins. Now think about aggressive and conservative execution. An aggressive trader may tighten the stop above June 10th U.S. midpoint. The risk becomes smaller. Position size can become larger. The ratio improves. Sometimes the market never touches that tight stop. The trade pays fast. But compressed ranges can shake hard. A small dip can touch the stop. Then price can still rise toward the target. The trader reads the direction correctly. The position disappears. A conservative trader respects the midpoint stop. The position size becomes smaller. The trade survives more noise. But if the stop becomes even wider, the target must also change. A wider stop with the same target can damage the ratio. That is why the stop, entry, and target must always be read together. Never move one line without checking the others. Now management. When price moves toward June 8th U.S. midpoint, watch the distance. If distance expands cleanly, hold. If reaction speeds up, protect. If price stalls under the target, do not force continuation. The market is still inside a dense weekly field. The 20 moving average and 120 moving average areas can also slow movement when price rotates inside the box. Double Bollinger pressure can widen and contract around the same zone. But the trade still starts from the session line. Indicators help you see pressure. The box gives the execution. If price reaches target and still holds, a trail can be studied. But only after profit is earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. The stop must not sit too tight. Normal reaction can remove the position. The stop must not sit too loose. Then profit is not protected. So the stop follows structure. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not save a bad entry. The structure comes first. June 11th US gives the second message. Recent sessions are clustered. The range is compressed. The line must hold first. Then the trade opens. Entry: June 10th US upper boundary. Stop: June 10th US midpoint. Target: June 8th US midpoint. Risk-reward ratio: 2.29. Price reaches. It reacts. It holds. Then the long earns execution. Price tests the top, but it cannot stay above. The session forms above compressed support. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a bounce can look ready and still fail at the next line. A short can look risky and still pay after upper memory fails. A long can look obvious and still lose control when the box cannot hold. That is why we focus on the session. Now look at June 11th Asia session. June 11th Asia session forms above June 8th US session lower boundary. It compresses by about 50%. It overlaps there. The session forms inside a crowded 1-week area. That matters. Recent sessions are not spread cleanly across the chart. They are packed. US boxes and Asia boxes keep overlapping. Compression, expansion, and overlap keep appearing in the same region. That creates short distance. It creates faster reaction. It creates earlier failure. Price can touch a line and turn quickly. So the trade must come from the boundary, not from the middle. June 11th Asia session continues inside its own basis box. It tests the upper side. Then it falls. It tests June 11th US session midpoint. That movement gives the short. Upper test. Failure. Return to the midpoint. Now build the trade in the correct order. Stop line first. Entry line second. Target line third. June 11th Asia short setup. Entry line. June 11th Asia session upper boundary. Stop loss line. June 8th US session upper boundary. Take profit line. June 11th US session midpoint. Risk-reward ratio, 1.96. The entry sits at June 11th Asia session upper boundary. Why there? Because price must prove whether the upper side can hold. If price reaches June 11th Asia upper boundary and stays above it, the short has no reason. If price reaches that upper boundary and cannot stay, buyers fail. That failure gives the short. The short is not a blind sell. It is the response to failed holding. Price reaches. It reacts. It cannot stay. Distance does not open upward. Continuation fails earlier. Reaction comes back faster. Then the short becomes active. The stop sits at June 8th U.S. session upper boundary. Why there? Because June 8th U.S. upper memory is the higher failure line. If price recovers above that area and holds, the short loses control. The market is not only reclaiming the Asia upper side, it is attacking older U.S. memory. The short idea is damaged, so the stop belongs there. Not too close to the candle. Not placed from fear. Placed where the trade loses its reason. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at June 11th U.S. session midpoint. Why there? Because after the Asia upper boundary fails, price returns into the active U.S. memory. The midpoint becomes the first clean destination. It is not the lowest possible target. It is the target where reaction can appear. That makes the setup practical. Risk-reward ratio is 1.96. It pays enough, but it still needs a clean entry. If the trader enters late after price already moves down, the ratio weakens. If the stop is widened above June 8th U.S. upper boundary, the ratio weakens. If the target is pushed lower before price earns distance, the trade becomes hope. The short must be taken near the upper failure, not after the easy move is gone. Now watch the behavior. Price tests the upper side. It cannot hold. The move stalls. Pullbacks deepen. Reaction speeds up. Then price rotates lower. The target is June 11th U.S. midpoint. If price reaches that midpoint and stalls, protect. Do not assume a full breakdown. The market is still inside clustered session memory. A midpoint can stop the move. A lower boundary can react. A prior target can become the next entry. That is why the trader must stay flexible. Do not marry the short. Do not marry the long. The line decides. Now trader type matters. An aggressive trader may tighten the stop below June 8th U.S. upper boundary. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never reaches the tight stop. The short pays fast, but a compressed box can whip. A wick can touch the tight stop. Then price can still fall. The idea was right. The position is gone. A conservative trader gives the stop more structural room. The position size becomes smaller. The trade survives more noise. But if the stop becomes too wide, the target must also move lower. A wide stop with a close target destroys risk-reward. So the trader must check the three lines together. Stop, entry, target. Every change affects the trade. Now management. If price reaches June 11th U.S. midpoint, protect. If price breaks below it and holds, a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot sit too tight. Normal reaction can touch it. The stop cannot sit too far. Profit can disappear. So the stop follows structure. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, A conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not create the edge. The edge comes from upper failure. The edge comes from a stop that protects the real idea. The edge comes from a target that pays. June 11th Asia gives the third message. The market tests the top. It cannot stay. It returns to the midpoint. Entry. June 11th Asia upper boundary. Stop. June 8th U.S. upper boundary. Target. June 11th U.S. midpoint. Risk-reward ratio. 1.96. Price reaches. It fails. It returns. Then the short earns execution. Price moves inside the final cluster. But neither side pays enough. The session forms inside compressed weekly pressure. Before reading June 12th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has already spent the week inside crowded memory. Asia boxes and US boxes keep pressing into the same region. Compression appears. Expansion appears. Overlap appears. Then compression appears again. That is not clean trend behavior. That is a field of repeated tests. The closer the lines become, the harder execution becomes. Now look at June 12th U.S. session. June 12th U.S. session forms near June 11th U.S. session, upper boundary and midpoint. It compresses by about 50%. It overlaps there. The session forms inside the same crowded area. That matters. Price then moves higher. It tests June 8th U.S. session upper boundary. Then it moves lower. It tests June 12th U.S. session upper boundary. The move creates temptation. Long traders see the upper test. Short traders see the rejection. Both sides want action. But the trade still needs clean lines. Stop line, entry line, target line, and a risk-reward must pay. Now list the working lines. Weekly 0.33. June 8th U.S. session upper boundary. June 8th U.S. session midpoint. June 12th U.S. session upper boundary. June 12th U.S. session lower boundary. June 11th U.S. session lower boundary. June 10th U.S. session upper boundary. June 5th U.S. session upper boundary. Several of these lines are close. That is the problem. When lines get too close, the market can move but still not give a clean trade. Price can rise. Price can fall. Reaction can look sharp. But the stop and target do not create enough distance. That is where many traders force a trade. They see movement. They ignore the ratio. They enter because the candle looks clear. Then the stop is too wide, or the target is too close, or the entry comes too late. The account pays for bad structure. Now check the long idea. A long could try to use June 12th U.S. lower boundary or nearby support as entry. The stop could sit below the next lower memory. The target could be June 8th U.S. upper area or weekly 0.33. But the distance is not clean. If the stop is placed safely, the target does not pay enough. If the stop is tightened to improve the ratio, normal reaction can touch it. If entry is late, the ratio breaks immediately. So the long does not give clean execution. Now check the short idea. A short could try to use June 12th U.S. upper boundary or June 8th U.S. upper area as entry. The stop could sit near weekly 0.33 or above the upper cluster. The target could be June 12th U.S. lower boundary, June 11th U.S. lower boundary, or the nearby June 10th and June 5th upper memory. But the same problem appears. The lines are packed. The target is close. The stop can become too deep. The ratio struggles to reach 1.5 cleanly. If the trader tightens the stop, the trade becomes fragile. If the trader widens the stop, the trade loses reward. So the short also stays weak. That is why the best decision can be no trade. Not because the chart is quiet. The chart is active. Not because there are no lines. There are many lines. Too many lines are too close. That creates noise. The final session of the week adds more risk. Weekend pressure can change behavior. Liquidity can thin. Traders can close positions. The market can move fast without giving clean follow-through. So the final filter becomes strict. If long and short combinations do not produce clean 1.5 risk-reward, skip. No trade protects the account. No trade saves capital for the next clean setup. No trade keeps the trader from paying for a crowded range. Now compare this with the previous sessions. June 10th Asia gave a long with risk-reward 1.58. It was not huge, but the lines were clear. June 11th US gave a long with risk-reward 2.29. The defended line and target gave better structure. June 11th Asia gave a short with risk-reward 1.96. Upper failure created space to the midpoint. June 12th US gives movement, but the combinations do not pay cleanly. That contrast matters. A trader must know the difference between movement and execution. Movement is what price does. Execution is where the account can survive. The market can move without giving a trade. That is not a missed opportunity. That is a saved mistake. Now trader type matters again. An aggressive trader may try to force a tight stop. The stop becomes smaller. The ratio may look better. But inside a compressed cluster, tight stops get hit often. A small wick can remove the position. Then, price can move in the planned direction. The trader was early. The position is gone. A conservative trader may use a wider stop. That can survive noise. But then the target must move farther. If the farther target is not realistic, the trade should be skipped. A wider stop with a close target is not conservative. It is bad math. So both styles reach the same answer. No clean trade. Now, management for no trade. Do not sit and wait for a candle to convince you. The filter already answered. If stop, entry, and target do not align, the account waits. If the market breaks clearly later, wait for the next session memory. If price reclaims and holds above the cluster, a future long can form. If price fails and returns below the cluster, a future short can form. But during the final crowded session, the best action can be no action. That is still execution. The week ends with a lesson. The same method that takes trades must also reject trades. It took the long when the line held. It took the short when the upper side failed. It skipped when the lines did not pay. That is how the account survives. Price reaches. It reacts. It holds or fails. But if the risk does not deserve the reward, the trader does nothing. June 12th US gives the final message. Compression is not always opportunity. Overlap is not always entry. A famous line is not enough. A strong candle is not enough. Only clean structure earns the trade. Stop. Entry. Target. Risk-reward. If those do not align, the week ends with no trade. Price moves fast on the 1-hour chart, but the larger chart controls the distance. The week now sits between major memory. The 1-hour chart showed action. The daily chart shows the path. The weekly chart shows the trap. The monthly chart shows the damage. That order matters. A 1-hour bounce can look strong. But if the daily chart already broke several lower boundaries, the bounce still needs proof. A 1-hour long can pay. But if weekly 0.33 sits above, the trader must protect faster. A 1-hour short can look late. But if the monthly candle is still pressing lower, the short can still have room. That is why we step back. Not to predict, to locate. This week, the daily chart shows price moving after the June 1st daily basis candle formed inside the empty space between February and March daily memory. That empty space did not protect price. Price traveled through it. Then April lower memory failed. Then March lower memory failed. Then price reached the February 5th key low. The 1-hour chart felt aggressive because the daily chart had already opened the lower path. Now the weekly chart gives the trap. June 1st weekly basis candle expanded inside the February weekly box. It absorbed March and April memory. It moved near the lower side of June memory. Now price stays between weekly 0.25 and weekly 0.33. That is not clean bullish recovery. That is lower rotation inside weekly memory. Then the monthly chart shows the larger pressure. June monthly candle is testing the February monthly low. It remains a large bearish candle. May already failed at the 2026 monthly lower boundary. April stayed between 0.33 and 0.5. March left the upper wick. February created the damage. June is now testing that damage again. So next week cannot be simple. Not long only. Not short only. Not bounce because price looks low. Not short because price looks weak. The plan must stay conditional. If price reclaims weekly 0.33 and holds, then the long can be studied through 1-hour session memory. If price reaches 0.33 and fails, the short can form again. If price loses the February 5th key low and cannot reclaim, weekly 0.25 becomes the next pressure zone. If price holds the key low but cannot build distance, no trade can be correct. The higher time frame does not give the entry. The session gives the entry. But the higher time frame tells us whether the entry has space. That is the difference. Many traders enter only because price touches a famous level. That is not enough. The level must hold or fail. Then the stop, entry, and target must align. If the ratio does not pay, the account waits. This week gave that lesson again. Some trades worked. Some setups moved. The final crowded setup was skipped. That is not hesitation. That is execution discipline. Now look at daily, then weekly, then monthly. Each chart shows why the 1-hour trades behaved the way they did. Price breaks lower, but the daily chart already lost the path. June forms inside empty memory. Look at the daily chart. June 1st daily basis candle forms exactly in the empty space between the February 1st daily basis box lower boundary and the March 1st daily basis box. It does not form safely inside bullish recovery. It does not form above strong memory. It forms in the gap. That matters. When price forms inside empty space, it can travel quickly. There is not enough structure to slow every move. Price can move from one boundary to the next. Distance can open faster. Reaction can come later. Then when a major level finally appears, reaction can become violent. That is what happened. After June forms in that gap, price falls. It breaks below the April 1st daily basis box lower boundary. That is the first failure. April memory cannot hold. Price reaches. It reacts. It cannot recover. Then the next lower level opens. Price falls again. It breaks below the March 1st daily basis box lower boundary. That same area connects with weekly 0.33. That is the second failure. Now the daily chart is no longer only pulling back. It is breaking stacked memory. April fails. March fails. Weekly 0.33 fails. Then price falls into the February 5th key low. That area matters. The February 5th key low sits near the rising trend line area. It also sits near weekly 0.25. So price does not fall into a random low. It falls into a higher time frame decision zone. That is why the 1-hour chart becomes difficult there. Short traders see continuation. Long traders see key low reaction. Both sides want action. But the trade still needs proof. When price reaches the February 5th key low, a long can form only if the level holds. A wick is not enough. A green candle is not enough. Price must hold session memory. Price must reclaim the active line. Price must create enough distance to the target. If the stop has to sit below the key low, the target must pay. If the target is too close, the long is skipped. If the entry comes late, the long is skipped. If price breaks the key low and cannot reclaim, the short can form. But the short also needs structure. It cannot be a chase after the red candle. It needs failed reclaim. It needs a stop above the failure. It needs a target before weekly 0.25 or the next lower daily memory. If that target does not pay, the short is skipped. That is how the daily chart becomes a trading plan. Not prediction. Plan. Look at how the 1-hour chart behaved this week. Price bounced from lower memory. Then it returned to old session lines. Targets became entries. Upper tests failed. Compression created faster reaction. The daily chart explains why. The market was not moving through a clean bullish zone. It was moving after April and March daily memory had already failed. So every bounce needed proof. Every long needed protection. Every short needed reward. Now the current daily structure is still tight. Price is near the weekly 0.33 area. The February 5th key low stays below. The daily candle reaction has not created full freedom. It has only defended lower memory for now. That creates next week's plan. If price reclaims the March 1st daily lower boundary and holds, then recovery can move toward April lower memory. But do not chase the first push. Wait for reclaim. Wait for retest. Wait for distance. If price fails under weekly 0.33 and returns lower, short pressure can revisit the February 5th key low. If price breaks below the February 5th key low, weekly 0.25 becomes dangerous. If price stays between weekly 0.33 and the February 5th key low, the 1-hour chart can rotate again. Then trades must be smaller. Targets must be closer. Stops must be respected. No trade becomes important. The daily chart gives one warning. Important levels create movement. But movement alone does not create execution. The level must hold or fail. Then the session must give a clean line. Price reaches. It reacts. It holds or fails. Only then does the trade begin. Price stays near the weekly lower side. But the trap began before June. The weekly chart shows why this area still controls the next trade. Look at May 1st. May weekly candles broke below the May 1st weekly basis box lower boundary. Then price moved down. It tried to test the March basis box upper boundary. That same area aligns with the April basis box upper boundary. Price failed there. That failure mattered. It could not reclaim higher weekly memory. It could not build distance above the old structure. Then the market rotated lower. June 1st weekly basis candle forms wide. It fully contains the April basis box and the March basis box. It overlaps inside the February 1st weekly basis box. That matters. June does not form in a new bullish area. June forms inside old February memory. But it forms with expansion. That is different from the months before. March 1st weekly basis candle formed compressed inside February. April 1st weekly basis candle formed compressed inside March. May 1st, weekly basis candle formed compressed near the February upper boundary. Compression kept building. Pressure kept gathering. Then June expanded inside February. Compression creates pressure. Expansion creates range. When expansion appears inside an old box, price can move hard from one side of memory to the other. That is why the 1-hour chart had sharp movement. It was not random. The weekly chart allowed the travel. Now price is moving near the lower side of the June weekly basis box. It sits between weekly 0.25 and weekly 0.33. That area must stay visible next week. Weekly 0.33 is above price. Weekly 0.25 is below price. The February 5th kilo sits near the lower pressure field. The rising trend line is near that area. The falling trend line still presses from above. Price is not free. It is trapped between major lines. Now look at the trend lines. From February, price moved between the first falling trend line and the second falling trend line. Then price broke upward. But the breakout did not create clean freedom. Price moved sideways again. Now price is caught between the second falling trend line and the third falling trend line. The falling trend lines are spaced with similar proportion. That matters. Pressure repeats. That matters. June does not form in a new bullish area. June forms inside old February memory. But it forms with expansion. That is different from the months before. March 1st, weekly basis candle formed, compressed inside February. April 1st, weekly basis candle formed, compressed inside March. May 1st, weekly basis candle formed, compressed near the February upper boundary. Compression kept building. Pressure kept gathering. Then June expanded inside February. Compression creates pressure. Expansion creates range. When expansion appears inside an old box, price can move hard from one side of memory to the other. That is why the 1-hour chart had sharp movement. It was not random. The weekly chart allowed the travel. Now price is moving near the lower side of the June weekly basis box. It sits between weekly 0.25 and weekly 0.33. That area must stay visible next week. Weekly 0.33 is above price. Weekly 0.25 is below price. The February 5th kilo sits near the lower pressure field. The rising trend line is near that area. The falling trend line still presses from above. Price is not free. It is trapped between major lines. Now look at the trend lines. From February, price moved between the first falling trend line and the second falling trend line. Then price broke upward. But the breakout did not create clean freedom. Price moved sideways again. Now price is caught between the second falling trend line and the third falling trend line. The falling trend lines are spaced with similar proportion. That matters. Pressure repeats. The market breaks one channel. Then it gets caught in the next. The rising trend lines also span with similar proportion. They create lower reaction zones. So next week the trend lines cannot be ignored. If price reaches the falling trend line and fails, short pressure can return. If price reaches the rising trend line and holds, reaction can form. If price breaks one of these lines and cannot reclaim, continuation can appear. But the entry still comes from the session. The weekly chart gives the field. The 1-hour chart gives the trigger. Now connect the weekly boxes. March compressed inside February. April compressed inside March. May compressed near February upper memory. Then June expanded inside February. That sequence shows pressure changing. The market spent months getting tighter. Then June opened the range. Now price sits near the lower side. That makes next week critical. If price reclaims weekly 0.33 and holds, the long can form later. But not by guessing. The reclaim must hold. A session box must support the move. The stop must sit below real failure. The target must pay. If price reaches weekly 0.33 and fails, the short can form again. A failed reclaim at 0.33 would show buyers cannot hold higher memory. Then the target can return toward the February 5th key low and weekly 0.25. If price loses weekly 0.25 and cannot reclaim, the structure becomes heavier. That would open deeper weekly risk. But again, do not chase the breakdown after the distance is gone. Wait for failed reclaim. Wait for session memory. Wait for risk-reward. The weekly chart also explains why many one-hour trades look like flips. Longs worked from lower memory. Shorts worked after upper failure. Targets became next entries. That happens when price rotates inside weekly memory. The trader cannot marry direction. The trader must read the boundary. If lower memory holds, the long can work. If upper memory fails, the short can work. If the middle gets crowded, no trade protects the account. Now the weekly plan is clear. Price is between 0.25 and 0.33. The next week is about reclaim or failure. If 0.33 holds above price, pressure stays heavy. If 0.33 is reclaimed and defended, recovery can continue. If 0.25 is tested and lost, the downside field opens again. If price rotates between them, trade smaller or wait. The weekly chart gives the environment. Expanded June box. Old February memory. Failed May structure. Repeated falling trendline pressure. Rising trendline reaction. The trader does not guess inside that. The trader waits for the session line. Price reaches. It reacts. It holds or fails. Then the trade earns execution. Price tests the February low, but the monthly candle still carries heavy pressure. June monthly candle is testing the February monthly low. Weekly 0.25 sits below and close. The candle is still a long bearish candle. That matters. A monthly candle near the February low can create a strong reaction. It can also trap early buyers. The location is powerful. But power does not equal entry. Look back at May. May monthly candle tested the lower boundary of the 2026 monthly basis box. That same area connected with weekly 0.55. May failed there. Price could not reclaim and stay. Then June rotated lower. That failure created the path. April formed between 0.33 and 0.5. It did not take back the upper structure. It stayed below major resistance. March left an upper wick. April confirmed that wick. Then price moved inside the February drop. February created the damage. March showed rejection. April overlapped the damage. May failed at the 2026 lower boundary. June returned to the February low. That is the sequence. Drop. Reaction. Failure. Return. That sequence still controls the chart. The 2026 first monthly basis box overlaps the lower boundary of the 2025 first monthly basis box. That overlap matters. Old yearly memory and current yearly memory are connected. May tested that area and failed. So June is not moving from clean bullish recovery. June is moving after failed monthly reclaim. Now the monthly chart is forcing a decision near the February low. If June holds above the February low and reclaims 0.33, the long can be studied later. But the long cannot begin only from hope. A monthly low touch is not enough. A one-hour reclaim must appear. A daily hold must follow. The weekly chart must start to recover. If price holds the low but cannot reclaim 0.33, the move can remain only a reaction. A reaction can pay a short-term long, but it is not full recovery yet. If price breaks below the February monthly low and cannot reclaim, the short pressure stays active. Then weekly 0.25 becomes critical. If weekly 0.25 breaks and fails to recover, the monthly chart opens deeper risk. But even then, do not chase after distance is gone. Wait for failed reclaim. Wait for the next session line. Wait for risk-reward. The monthly chart gives the largest warning. Both sides can get trapped here. Buyers can enter too early because the February low looks important. Sellers can enter too late because the candle looks weak. Both can fail if the structure does not pay. So the monthly plan must stay conditional. If price holds the February low, watch for reclaim. If price fails the February low, watch for failed reclaim short. If price rotates around the low, protect the account. No trade can be correct. Now connect the full map. The daily chart shows June forming an empty space, then breaking April and March memory before testing the key low. The weekly chart shows June expanding inside February memory after months of compression. The monthly chart shows June testing the February low after May failed the 2026 lower boundary. The 1-hour chart gave the trades. But the higher time frame gave the reason. Monthly location, weekly trap, daily path, 1-hour execution. That is the full structure. Next week, do not predict the bottom. Do not chase the crash. Do not buy only because the candle looks low. Do not short only because the monthly candle is red. Wait. If price reclaims weekly 0.33 and holds, the long can form. If price fails under weekly 0.33, the short can return. If price breaks the February low and cannot recover, downside pressure grows. If price stays trapped between 0.25 and 0.33, the account must stay selective. The method is simple. Price reaches. It reacts. It holds or fails. Then the trade begins. If the risk does not deserve the reward, the trader waits.